You know, the absolute biggest risk to your FIRE plan, financial independence, retire early, is actually not investing. It's withdrawing. We spend decades obsessing over accumulation, right? How much to save, which index funds to buy, how to get that compound interest working for us. But the reality is, once you cross that finish line, the whole playbook changes. The biggest risk to your FIRE plan is not investing, it's withdrawing. The second you stop putting money in, the math and the psychology completely flip. Suddenly, taking money out is the most dangerous thing you can do to your carefully crafted plan. Now, before we get into the exact mechanics of how this works, just a quick disclaimer. This explainer is strictly for educational purposes. It's not financial advice. All right, let's look at the numbers. Imagine you've done everything perfectly. You saved aggressively, invested consistently, and built up a beautiful $1.5 million portfolio right here in the US. You hand in your notice to your boss, pack up your desk, and you think, hey, I won the game, right? Well, hold on a second. Because the next 30 or 40 years are just starting, and the game fundamentally changes. You're shifting from growing wealth, adding money in during your working years, to protecting wealth, where you're suddenly reliant on taking money out. You are moving from accumulation to decumulation. Which brings us to the decumulation danger, surviving the withdrawal phase. Because listen, just because you handed in your badge and stopped working doesn't mean the real world stops spinning. Inflation, market moves, unexpected expenses, they are all still there. Imagine suddenly needing a $10,000 roof repair or getting hit with a massive medical bill right in the middle of a recession. Your new full-time job isn't aggressively growing your money anymore. It's actively protecting it against these constant pressures. It's a financial tightrope walk. If you play it too safe and move everything to cash, inflation just quietly eats your purchasing power over the decades. But if you play it too aggressively to beat inflation, you risk catastrophic drops that you literally can't recover from. You need growth, for sure, but you desperately need stability. Think about what happens when the market drops. It shrinks your overall portfolio. But if you have to withdraw money to buy groceries during that exact drop, you are mathematically accelerating your losses. You're selling your hard-earned assets at rock-bottom prices, and that money you pull out can never, ever participate in the market's eventual recovery. But honestly, the math is only half the battle. The behavioral threat is where you can easily become your own worst enemy. When markets drop, panic selling kicks in hard. People log into their brokerage accounts in a cold sweat, sell off their life savings, and run to the perceived safety of cash at the absolute worst possible time, out of pure fear. It's the fastest way to destroy a long-term plan. And on the flip side, greedy risk-taking during market highs. When the market is on a multi-year tear, overconfidence sets in. People feel invincible and take on way more risk than they ever should. Both of these massive emotional extremes are incredibly dangerous to the sustainability of your wealth. So, how do successful early retirees handle this volatility without losing sleep? Let's talk about strategies for survival and creating a flexible approach. The absolute baseline is diversification, spreading your investments to manage overall risk. You're not just betting on one horse or dumping everything into a single tech stock. You're spreading it out across multiple asset classes. And to keep that diversified portfolio on track, you need rebalancing. This keeps your portfolio aligned with your target risk level. You're automatically selling a little of what's up, buying a little of what's down, without ever trying to perfectly time the market. Then there's adjusting your withdrawals, taking out less money when markets are down. When things get scary, you tighten the belt. You scale back your discretionary spending temporarily to fiercely protect your core principal when it's vulnerable. And to make that painless, you use a cash buffer, keeping funds set aside to avoid selling investments at a loss. If you have 1 to 2 years of living expenses sitting in cash, you've got the ultimate shock absorber. Market drops 20%, you simply pull from your cash instead of selling at a massive loss just to pay your electric bill. Which brings us to the ultimate question: survival or perfection? Take a second to really think about that. The goal of all this flexibility isn't to perfectly optimize every single dollar to maximize returns. The goal is pure survival. It's making absolutely sure your money outlives you. And that requires the preservation mindset, a true paradigm shift. FIRE isn't some magical finish line where you pop champagne and stop managing your money. It's the very start of a decades-long balancing act. It means less focus on growth and a massive pivot to a focus on sustainability. You need an ironclad strategy and the emotional fortitude to stay completely calm when the numbers on the screen look terrifying.
Because at the end of the day, building wealth simply gets you to FIRE. All those sacrifices, the skipped vacations, the aggressive saving, that just gets you to the starting line of early retirement. Preserving wealth is what actually keeps you there. And the longer your retirement is supposed to last, the more crucial that preservation becomes. So, are you prepared to stop accumulating and start surviving? Make sure your plan is built to weather the entire ocean, not just the harbor.